The importance of fundamental analysis in Forex trading. Welcome, dear follower, to our channel. If you're someone looking for safe, trustworthy trading companies that offer instant withdrawals, then you're in the right place. In this video, we provide you with an exclusive list of the best trading companies known for their high credibility and beginner-friendly experience. Trusted companies, hassle-free deposits and withdrawals, continuous support and premium services. The registration link is available below the video. Choose the most suitable one for you and start your journey with confidence. And don't forget to subscribe to the channel and turn on the notification bell to stay updated with everything new in the world of trading. Let your financial future start from here. What is fundamental analysis in Forex, and how does it help predict currency movements? Fundamental analysis. In the Forex, or financial markets in general, is the process of examining and evaluating economic fundamentals that could influence market movements, with the goal of predicting future price changes. It focuses on the general economic situation and studies various key factors such as interest rates, employment rates, gross domestic product, GDP, international trade flows, industrial production. All of this is done to assess how these elements affect a currency's value. What is fundamental analysis in Forex? Fundamental analysis in the Forex market is an approach aimed at evaluating a currency's value by examining the economic, political, and social factors that could impact it. It includes analyzing external influences, economic data, and market trends. Fundamental analysis is one of the main tools used to analyze financial markets, alongside a technical analysis, but differs in methodology. What's the difference between fundamental and technical analysis? Technical analysis focuses mainly on studying price charts and historical price movements to identify patterns and predict future trends. It relies heavily on graphical data. In contrast, fundamental analysis examines external factors that might impact the financial asset. This includes reviewing economic news, government reports, geopolitical events, and more. The goal of fundamental analysis is to understand the underlying forces affecting supply and demand to determine the real value of the asset. Explaining fundamental analysis in Forex. In Forex, fundamental analysis relies on understanding economic factors that influence currency values. A strong economy is seen as a positive signal that boosts a currency's value. This is because a healthy economy attracts foreign investment and encourages business growth, increasing demand for the local currency. Foreign investors buy the currency to invest or start businesses, increasing demand and reducing supply, which raises the currency's price. For example, when it comes to the US dollar, the strength of the American economy reinforces its value on a global scale, making it attractive to investors. Quantitative versus qualitative. Fundamental analysis. These are two different approaches to evaluating financial assets. Quantitative analysis. 1. Numerical data. Relies on measurable figures like revenue, profits, and costs. 2. Financial ratios. Uses indicators like debt-to-equity ratio or net profit margin. 3. Future projections. Estimates future company performance based on financial metrics. Qualitative analysis. 1. Non-measurable factors. Includes reputation, consumer confidence, and market perception. 2. Psychological elements. Considers consumer expectations and investor sentiment. 3. Experience and history. Takes into account how long a company has been in the market. Importance. Both approaches are valuable, and quantitative analysis offers precise financial insight. Qualitative analysis helps understand the non-numerical factors influencing value and market behavior. Best tools for fundamental analysis. Here are key tools and sources to understand the economic factors affecting currency values. Economic reports. Unemployment rates reflect labor market conditions. Interest rates affect borrowing, investment, and currency strength. Economic news, daily updates and geopolitical events impacting the markets. 3. Quarterly and annual reports. Review companies' performance through earnings and forecasts. 4. Economic indicators. Consumer indicators like retail sales show consumption trends. Industrial production shows manufacturing activity. 5. Sentiment indicators. Consumer and business confidence indexes. 6. Central bank reports. Statements and data from central banks significantly impact currency prices. 7. Financial news and economic analysis. Use news platforms and analysis sites to stay updated. 8. Specialized blogs and websites. Follow experts and professionals in Forex analysis. What happens when the U.S. raises interest rates? When the U.S. government raises interest rates, the U.S. dollar typically strengthens against other currencies. This is because higher interest rates make the U.S. financial market more attractive due to better returns and perceived safety. Positive economic growth and low unemployment signal a thriving economy, making the currency more attractive to investors and traders. This opens up opportunities for traders to buy or invest in the currency in anticipation of its rise in value. Those who follow fundamental analysis may enter early before the actual rise occurs, leveraging predictions to make long-term profits. Key economic indicators used in fundamental analysis. 1. Interest rates. One of the most influential indicators in fundamental analysis. 2. GDP, gross domestic product. Measures the total value of goods and services produced in a country. Reflects economic growth or recession. 3. Unemployment rates. Show the health of the labor market. Indicate economic strength or weakness. 4. Inflation indicators. Like the Consumer Price Index, CPI, which tracks price increases. Affect interest rates and currency strength. 5. Balance of trade. Difference between exports and imports. Reflects currency demand and economic health. 6. Government budget. Difference between government revenue and spending. Affects national debt and fiscal strength. 7. Consumer and business confidence. Gauges how optimistic consumers and companies are about the economy. Influences consumption and investment. 8. Industrial production reflects manufacturing activity. Affects GDP and employment.